All right, we are living in an exciting time. Last week in the stock market, we saw some red days and then it ended on a green day. It's going to be looking forward to this week to see how the fluctuations, if volatility is going to start to return. There's a lot of pressure, selling pressure in the market, so it'll be interesting to watch. Now, I feel like I should start these videos with this generic kind of disclaimer that says, of course, I only record these videos for fun on my part. I'm not trying to sell you anything, and I do not want you to try to follow me. These are not trade recommendations. I'm not qualified to give investment advice. I'm not a professional. I'm not licensed. You're going to have a high chance of losing money trading options. You could possibly lose more than your initial investment if you don't do it correctly. So, generic disclaimer, please just take this for what it is, which is just some interesting stock stuff. I do have, if I look at my account this weekend, I do have 4 open short calls. These are covered calls. I own the underlying stock and I shorted the call options. So Digital Ally, Invesco, Mark, and Latam. And all of them are short and all of them are out of the money, which means I get to keep all the premium. I have collected $940 of actual premium on these things. And if the stock prices don't change on any of them by Friday, I get to keep it. So that's pretty good. I have around $5,100, almost $5,200 in the market on those 4 stocks. And if I keep the $940 premium, that's 18% ROI. And I did some crazy math in terms of, let's say, started on this on June 1st to June 19th. It was about 700% annual return, but we'll see. I'm going to look to close out those trades. So typically, I could hold them all till Friday and then just they expire worthless. But if I can sell them, if I can buy them back for 5 cents or even 10 cents, but 5 cents ideally, then I can close the position and I take the risk off the table for $5. That would be great. So I'm going to keep an eye out for that. The other option, of course, is once I close out the position is I can then sell the July calls and just roll into the following month. And if I can do this month after month, this is how you keep income coming in from covered call strategy. But the thing to keep in mind is a couple of these stocks have earnings coming out. So I did a check today to see when the earning dates are on all of them. And for instance, Invesco has earnings on Monday, next Monday, so a week from now. So if I can close out the short June call, I won't create the July call until after earnings. So there's going to be a time gap between closing out the June and opening a July call. Same thing for Mark. Mark has a following Friday, so 2 weeks from now, the earnings are there. So if I can close out the June call, great. And I'll just have to be patient and wait an additional week for the July call. Now I am short some of the Julys on another trade, but I'll just have to be patient. Mark's been pretty good. Mark has not fluctuated too much, and the stock market that's been going up and going down, Mark has been pretty reasonable lately. So the other thing I want to talk about, so that was the covered call and where I'm standing, what I'm looking at. There's a cheaper way to do this. It's called a poor man's covered call. It's also called a vertical call spread or a bull call spread. And so I thought I would take a couple minutes to talk about how I can even de-risk this even further. So take one of my open positions, which is to own Mark at $2.29 and to sell the $2.50 call on it, right now valued at 20 cents. If I was to open this position on Monday morning, it would probably cost me $209 net, right? The $2.29 minus the 20 cents. And I could make a maximum profit of $41 on the premium that I collected, plus if Mark was to get to $2.50, the difference between the strike and the current price. So in that 5-day period, it's a 19% ROI, which is pretty good for 5 days, right? But there's a way to even improve this. Like you can open what's called a bull call spread, which means instead of owning the stock, you own a call on the stock. So I could buy a $1 call. It cost me $1.30. as opposed to 100 shares, which would cost me $2.29 per share. So then I can sell the same call, and instead of paying $2.09, I would pay only $110. That's $99 less. And instead of making 41 profit, I would make 40 profit. So I would go from a 19% ROI to a 36% ROI. So basically the same play, lower cost, same profit, everything, basically when I was analyzing this trade, there's not really any financial risk, right? The call is cheaper. There's no time value. There's only 1 penny of time value in that call. And $99 less risk and the same profit. So how can that be any downside? Well, the only thing I can think of is, of course, option trading has higher costs. We don't talk about transaction costs so far in this channel, but I am paying $6 more for a trade than a stock trade. There's also what I'm experiencing is some strange changes to option pricing. So option pricing is more affected by volatility than it is by the stock price. So what I mean is if the stock price was to go up by 10 cents, you would expect the call would go up by 10 cents, the at the money call. But you don't always see that, right? So it doesn't always track penny for penny. And really, if the stock was to go up by $1 and then to come back down by $1, and it would close the day exact same as the opening with 0% change, but there was a lot of volatility, well then the call option is going to go higher. And so you're actually at a risk of losing money even if the stock price doesn't change. Then you just have to hold it until expiry. So the volatility is one of those weird things, and then the time value. So we said that we could sell a call for let's go back here. We can sell the call for 20 cents. That's only 5 days left. And so you would think, okay, if it doesn't hit 250, that call will be worth 0. Therefore, it's about 4 cents per day of time value. But it doesn't deduct. You wouldn't expect the call to be 20 cents on Monday, 15 cents on Tuesday, 10 cents on Wednesday, 5 cents on Thursday. You would not expect it to have that perfect time value degrade. And so it could be 20 cents on Monday, 20 cents on Tuesday, 20 cents on Wednesday, and then Thursday, 10 cents. You know what I mean? So it's some uneven stuff. So you just have to hold on. Those aren't very big downsides to me. I think the in the money bull call spread is kind of a no-brainer if you're going to do a covered call. So maybe I'm going to start to look at doing some of those trades. Now, I should mention there's a cousin to the bull call spread, which is an out-of-the-money bull call spread. So you could basically raise your strike prices and save a lot of money. So instead of the $1 $2.50 spread, you could do a $2.54 spread, and it would only cost you, see, that's 12 cents per share or $12. And so then you get the difference between the strikes, which is $1.50 in maximum profit. So $12 costs $1.50, 150 maximum profit. That's a 1,200% potential ROI. The thing is, this is a very low probability of profit trade. So this is literally a lottery ticket. It is sort of the speculative end of that. I think a lot of young people are getting into these now, but for $12, you potentially could make $150, but the stock would have to go to $4. It's currently $2.29, and you need it to almost double, maybe 75% increase in a week. There's no earnings. Well, I don't know what else news is going to come out, but it's really a gamble. There's got to be probably a profit calculator out there that would tell me what the percentage chance of the $4 call being in the money, but it's probably pretty low. So the break even, if you go back to this, the break even here is that you are paying 12 cents, and so the stock would have to get to what are we talking, like 265 in order to even break even. So it's like you still need and it's currently 229, so you need a 10% rise in the stock price just to break even. So it is a lottery ticket, but that's maybe that's your level of, maybe you're willing to take that risk. $12 isn't too much, and sometimes those things are going to win, especially if you're really bullish on the stock. Then it might be worth it. Another point we're going to talk about, like calendar spreads and being able to sort of use the time in your favor. This is a very short period of time, but there probably are ways to use time in your favor. The last thing I want to mention regarding this type of play is, let's look at what's going to happen on Friday. So a lot of my options here expire on June 19th. There is a phenomenon in the stock market called pinning. And so when a stock is expiring, obviously a lot of traders are in the market trying to predict where that stock is going to fall at end of trading on Friday. That means there's a lot of pressure on both sides. There's going to be people who want the stock to be a little bit higher because their options are out of the money. There's going to be people who want the stock to be a bit lower because they are on the other side of that trade and they want those options to be expire worthless. And so it's a bit of a battle. I read about people would expect, let's say the Mark stock, a lot of the volume is around the 250 strike. And so perhaps there's going to be people who are going to be buying the stock at 249, trying to get it higher because they need it to be above 250 to have value. And there's going to be people who are trying to sell the stock above 250 to get it lower. And so there's going to be a lot of push back and forth, like a tug of war around that 250 price. That's one of the reasons why I don't think it'll get to $4, because somebody's going to lose a lot of money if Mark gets to $4. There's several $1 million of open options at the $4 mark. And so, someone may not want to lose $4 million, and so they're going to try to manipulate the stock temporarily. And that could mean by the following Monday, the stock explodes, and you're like, man, if it was only one more day, I would have made money. But that's intentional, right? So you have to sort of keep your eye out for that. Anyways, I've been going on long enough. Thanks a lot, guys. I'm looking forward to tomorrow, and we'll talk to you then.